All right. Welcome everyone to Bernstein Fireside Chats. I have with me the founder and MD of Equitas Small Finance Bank, N Vasudevan. Welcome, Vasu, and pleasure to have you with us. Before we go on to questions, I would like to tell everyone Vasu is one of the most impressive professionals I've met in financial inclusion. I know him back from his sort of unlisted days when Equitas used to be part of our portfolio in a private equity fund, CDC. Just very interesting. Equitas was also one of the most first to actually launch a small finance bank and on ground without hiring any consultants, and probably spent the lowest amongst all small finance banks and still had such an impressive launch. So Vasu, congratulations on that, and you've come a long way from the launch, and welcome. Vasu, you're on mute.
Yeah, thank you, Gautam.
Great. So Vasu, I think let's start by, given that this was a topic we wanted to cover, the small finance banks, and this is a space that has had, we've had sort of, I would say, fair to say we've had sort of mixed success with this model, and at least the perception is that the success of the small finance banks has been kind of mixed, given that there were almost 12 licenses given. What would be interesting is how do you think this model was originally intended, and sort of 3 years down the line, how do you think it has kind of evolved? We could start with that and then sort of get into more questions.
Yeah. So thanks Gautam. Thanks for hosting me and hosting this conversation. The small finance bank concept goes a long way back. Basically, it's coming from the concept of financial inclusion. So RBI and the government of India have been, of course, trying a lot of initiatives in terms of financial inclusion. Way back in 1995, RBI came out with this concept of local area banks. The idea is that a local area bank would just cover 3 contiguous districts within a state, and only operate within that, with the understanding that, with the expectation that they will understand that market so very well and the population so very well that they will be able to provide the best banking products and services for them, which no one else could provide. No, not a bigger bank, which none of the bigger banks could provide. So that was the first kind of an initiative that they had taken for financial inclusion. So they had licensed 6 local area banks, labs as they were called. 6 were licensed, but unfortunately they were given to a set of people. Somehow it did not work out. I think 3 of them closed reasonably soon, and 3 of them survived. 1 of them have now become converted into a small finance bank. There are still 2 more. And so that model never really took off. Then came the 2008 Raghuram Rajan report on high-level reforms in the financial services sector in India. So that was a committee appointed by the government of India and under Raghuram Rajan's head. And one chapter, I think it was chapter 3 of that report, which was exclusively devoted to the concept of small banks. For the first time, I think the word small bank was used in India. And the committee said that, the bigger banks, they don't have the ability to understand and service all profile of borrowers all across the country. So it's important that the RBI or the government should kind of come with a concept of small banks who could really, understand local markets and design products and services which are really suited for the local customers, with largely local people, local staff employed in the bank, etc. But after the 2008 suggestion, actually nothing much really happened. And finally, in 2013, when Mr. Raghuram Rajan was himself the governor, I think, he went ahead and implemented his own committee's recommendation. And then the RBI came out with a guideline. 2014, they came out with a guideline for small finance bank. I don't know how many of you may be aware, but the first draft guideline which came from RBI for SFBs contained one big clause. That one big condition was that the area of operation. A small finance bank can only operate within an area of three contiguous states. Only 3 states a small finance bank could operate. So that was one of the conditions that was put down in the first draft guidelines which came for SFB. And it was put up for public feedback. So a lot of us gave a feedback, and our feedback to RBI was basically that, the word small should be for the word bank or for the word finance. So the word small represents a
For
smallness of the
finance
finance,
rather than
smallness of the bank itself. And why
right.
should it be representing the smallness of the bank itself? I mean, why should a bank be small to service a small customer?
Yeah.
So bank can be any size, but they should have the ability of the DNA to service a small customer. So that's where the whole. Then RBI came back and revised that guideline. When the final guideline was issued, they just completely removed the locality constraint. And so small finance banks are allowed to operate anywhere in the country. So that's how it is evolved. And today, basically, a small finance bank can be a very large bank, operate everywhere in India, whatever they want, they can do. But they need to focus on the small borrowing community, because you have a 75% priority sector target on you. So you necessarily have to focus a lot on the inclusion space. So that's how the concept of small finance bank has evolved over a period of time. And RBI themselves have kind of given a guidance that at the end of 5 years, a small finance bank, if it wants to, can convert into a universal bank, which can then be approved by RBI based on case to case. So there's kind of a direction given by RBI that small finance banks may also aspire to convert into a universal bank at some point in time. So given this background, I see that, the SFB, and we have 10 of us now, but I think we should not assume that this will be the 10 for a long time to come. There may be more people who can join. And the guidelines, of course, there's a on-tap guidance, on-tap licensing available now for SFBs. And I think 2-3 cooperative banks have already been given the license. Maybe they're in the process of converting. And many more people could apply over a period of time. NBOCs, for example, we know the liquidity issues that's going around in the NBOC sector and all that. So maybe more and more of the NBOCs might be tempted to start applying for a small finance bank license rather than continue as an NBOC format. So we might see over a period of time more SOBs coming in. And recently we have created an association for SOBs. It's called the Association of Small Finance Bank of India. We just formed an association for SOBs so that the association can then really take up the issues which are affecting the SFBs with either RBI or with the government in an appropriate way. So I see 3 models evolving for SFBs. Going forward, I see 3 models evolving. One is that an SFB can choose to remain in the small financing space, which means that large percentage of the book of that SFB might still be for the MFI customers or for typically informal economy borrowers of small ticket loans. So an SFB could choose to remain significantly a small financing entity, remaining in the informal economy, sector. In terms of growth, the demand for loans from the underserved and unserved segments in India is very large. If you take microfinance, if you take small business loans, if you take used commercial vehicles, if you take affordable housing finance, if you take all of this put together in India, based on various government statistics, the total demand, which is unmet demand, is somewhere in the range of 20 lakh crores plus. Right, 20 lakh crore, to put it into the right perspective, is against 100 lakh crores, which is a total banking credit exposure in India, all banks put together. So against that kind of 100 lakh crore bank exposure on credit, we're talking of 20 lakh crore, 1/5 of that remaining unserviced or underserviced today for the informal economy. So an SFB, even if an SFB says I'll remain largely in the informal sector, it doesn't mean that they need to be small. They can also be big because the demand is very large. The second model for SFBs which could evolve is some of the SFBs might move towards the universal bank model. And as they move towards the universal bank model, they might continue to hold on to the strength of being an SFB, which is basically the ability to lend and collect from the informal customers. That's the biggest differentiator between the universal and a small finance bank. The ability to credit assess based on cash flows, lend and be able to collect back from the informal economy. So an SOB might still retain that strength and keep building on top of that strength, but also add more and more of the formal products and formal economy customers to its portfolio, with the objective of maybe making their asset quality a little bit more stable and less volatile. So that could be the second way in which an SOB could evolve. And third is somewhere in between, people who are neither wanting to be just in the small financing segment, nor they have a very clear roadmap or a road path to move to a whole banking kind of a model. So somewhere they might be caught in between. So I think there are the three models which could evolve, which could all be determined based on the promoter, based on the management, based on the board's own, desires and views and vision for which they have for that bank. So I think these are the ways in which SOBs can evolve. But whichever model the SOBs evolve, I think what is one thing which is very clear is the potential to grow. The potential to grow is like is really not constrained by the demand side. It's not constrained by the level of demand. The potential or the ability to grow will be largely constrained by the management's own capability to manage growth and keep their asset quality under control. So any SOB which can manage to keep its asset quality under control, I think growth is more or less like it's a given.
So Vasu, on that note, let's speak about the constraints. Uh, the one of the fundamental constraints as one becomes a small finance bank is you become self-reliant on funding, uh, and uh, and the other constraint obviously is there are these constant headwinds that keep hitting on the asset quality side, given that this is you focus on the underserved segment, and in that light, the viability of the sort of the long-term model comes into question every time. So how would you address that?
Yeah. So the see, when you are serving people from the informal economy, naturally you are relying on their cash flow to service your loans. Anything, any event which kind of impacts the cash flow of the borrower immediately has an impact on your asset quality. So, you have situations where you have a flood, you have a cyclone, you have any kind of a natural calamity. Immediately, the cash flow of these people get impacted for a period of time. It could be 1 month, it could be 3 months, but there's a period for which their cash flow gets affected. And when the cash flow gets affected, then, obviously your portfolio goes, into overdues and things like that. So as I said, there are two ways in which you can address this. One is that you fundamentally have a pretty good margin, and that margin kind of takes care of some of the volatility that you might experience on your asset side from time to time, and your margin is good enough to absorb all these shocks and still give you a sustainable return. That is one way in which one could address that. The other way in which one could address that is by diversifying and trying to create a book which consists of diverse customer profile and customer segments, so that any impact in any one product segment or a customer segment or a geography doesn't affect you too much at the overall, and you can still manage to have a steady kind of an asset quality. I mean, there are two ways in which people could address that. I mean, it's a choice. People can make their own choices. I wouldn't really want to say which is better or worse. I think both can be managed well, provided you are able to do it properly. But in the second model, my belief is that you need to be a lot more liability focused, because you are then getting into areas where other banks probably are present. And so your cost of funds might become an important factor. So you might have to have a better focus on your liability if you want to move towards the model of trying to diversify and reduce your volatility on asset quality by through a process of diversified risk.
Yeah, so Vasu, I think given the sort of more specific to Equitas, uh, so two, one is a more higher level question in terms of where you think you're going. But before that, how have you dealt with these headwinds? Right, demonetization happened, asset quality went out of hand, liquidity crisis happened around the NBFC situation. Uh, there have been specific cases around microfinance related, moral hazard situations that have happened in the middle around political events, and now obviously this, which has affected everyone. What has been your crisis response, both on the deposit side, because we've seen a flight of deposits, and then on the asset side, particular to Equitas?
Well, I thought that this was a little bit more on the industry level and
No,
not
that's
much
fine.
about.
I just wanted to understand, just in terms of how would you want to what's the kind of, when such situations happen, how do you deal with it? I mean, what happens?
Okay. So, we have taken a view long back, not now, but even when we are an NBFC MFI, we have taken a view long back that we would like to go through the diversification route to, manage a steady kind of an asset quality portfolio. So we started our diversification long back in 2010, 11. We entered into commercial vehicle and then small business loan, etc. So over the last 10 years, we have been diversifying, and today we have a reasonably diversified mix of portfolio, which helps in terms of some level of balancing our asset quality. So when demon happened and all that, it impacted only at the time of demon. Our microfinance was about 53% of the book. The 47% of the book had no impact. Microfinance did, of course, have some impact. Today, microfinance is down to about 23%. So we have kind of even more diversified in the last few years. And I think that is a process that we would like to continue. At least we have taken the model that I was explaining earlier. So we have really chosen the second model in terms of diversifying our
middle.
book. Yeah.
What you said, which is in sort of the middle.
Yeah, so we have taken the route of diversifying so that we will continue to play to our strength, which is our ability to service, provide loans and collect it back from the low income and the informal sector. That's our strength. That's what we have built up over the last 13 years. We'll continue to play to that strength, but keep diversifying. Where we keep picking up, asset and customer segments which we can afford as our cost of funds keeps coming down. And so there's a lot of focus on cost of funds for us, and there's a lot of focus on the liability side in terms of raising enough liability, enough deposits to fund our growth, but at the same time keep our cost of deposit low so that we can continue to remain competitive and start increasing our focus on certain products which can be still profitable, based on our reduction in cost of funds. So that's the route we have taken. And of course, technology is a very big factor in this journey for us. Clearly, technology is a big part of the entire journey. And I think, it's there's enough of statements going around that technology is a big disruptor and all that. But I think in banking, it's really beginning to play. So far in India, I don't think technology really changed dramatically the way banking is being operated. But I think that's set to change now. And, we are bank number 118 in the country because my license is 108, which means I have 107 competitors in front of me, right? And so always we'll be looking, laggards, always. If somebody says, what's your branch network? You will have every bank which is far more having a bigger branch network than me. And if you say, what's your reach, what's your customer base, what's your anything, I'm going to be always looking exactly like my license number. I'll be looking like the 118th bank in the country on all parameters. But when it comes to technology, I think that's suddenly a big leveler. It's a great leveler because now technology, nobody is, 50 years or 30 years or 20 years ahead of me on technology. Everybody is either at the same level or maybe 1 month or 2 months ahead of me, nothing beyond. And so I think technology is something which not only us, I'm sure, all the small finance banks or all the small banks who have not been able to grow and compete against the bigger banks in terms of branches, network, and things like that. Now we can use technology, and we have got this video KYC rules released by RBI about 4 or 5 months back. So effectively now we can operate anywhere in the country. I don't need branches. I mean, I have 375 branches, but today I can acquire a customer from just about any single place in the country and convert him into a full KYC customer and enable him to do a full banking transaction with me, provided one, I have VKYC capability, of course, first, and second is that I should have a mobile and a net banking app which gives him complete freedom to do all the banking transaction that he needs to do by himself sitting in a remote location. So long as I can enable all of that, then I am a bank to him. It doesn't quite matter that I have no branch, not only in his place, but in his state I may not have a branch, but it should make no difference. So I think technology is a big leveler, and that's an area that I mean, of course, we are very focused on that, but I'm sure many of us are also equally focused. And so that's a thing that which I think can help us in terms of bridging this brand. What you mentioned, flight to safety of
Yeah,
deposits and all. We say that when the S Bank moratorium was announced by RBI in the first week of March, we could see a certain level of pressure on our bulk deposits. Deposits which are maturing were not coming back. They were
sure,
being withdrawn, and they're
sure.
not coming back. So that impact is definitely there. But I think over time, it takes time to build a brand, of course. But I think technology could help us maybe just build that a little bit faster and a little bit less costlier than what we could have otherwise done.
And when you talk about sort of, across all the small finance banks, and one of the areas, you said was somebody could become a universal bank and somebody could sort of remain, grow within the same space. Uh, where do you see the landscape evolving? I mean, there are some banks which are in north, there are some banks which are in south. So is there a regional focus? And you said technology is going to make us more national level players. So is there a regional focus? There are also these old regional banks, which also have this regional focus. And again, sort of from a technology perspective, I mean, why don't we just address that, and I'll come back on technology.
Yeah. So, so as an SOB tries to become a universal bank, of course, you might get a license from RBI. Is a different issue. At the end of 5 years,
Sure.
we are entitled to apply. They might approve it based on their regulatory comfort. So, but the license is not the only issue. I mean, you don't change your spots just because you have a new type of a license. So the license is only an enabler, but it doesn't immediately change your color. Your color can be changed only through your own approach, your own vision to start with, and your approach and your capability, and the level of capability that you have bring to the table in terms of executing your plans. So that is what will decide how much you are able to diversify and how much you are able to move towards a universal banking model. But now the question is that as you rightly say, we have a lot of regional universal banks which are very strong in their own domain, in their own customer segment, in their own geographies, and established over anywhere between 40, 50 to 80 to 100 years time period. So you will have your competition with them as you try to get into their markets and their products and customer segments. Yes, you will have competition with them. Uh, so that is where again my belief is that how disruptive can you be both on liability and on assets? How disruptive can you be in terms of using technology to create a better brand visibility for yourself, create a better aura or better image of being a very nimble and being a very innovative kind of a bank? How do you create that kind of sense of feeling within the both the borrower and the depositor segment? How do you create the differentiation between others and you? And second thing is that as you expand and as you diversify your product ranges, how do you ensure that you execute it in such a way that you are very clear, you have a very clear game plan of your mix? You have to have a very strong idea of the mix of the products, mix of the customer segments that you want to deal with, and each segment will yield what kind of margins and what kind of returns, and on an overall basis, how is that going to pan out? And then stick to those models. I think it's very important that you have a very clear plan, stick to that model, and then execute it relentlessly. I think if these are done, then I think that will help you distinguish between you and others who either don't have that clarity, maybe, or the ability to execute or whatever it is. I mean, if somebody can do it as well as you, of course, they can also do it. But the reality we know in India is that lots of banks have not been able to execute to a great plan. That's the reality. We have seen that over so many years. So your ability to distinguish need not be to go and do something, different from any of these banks. Just do it much more better, much more focused, and a lot more efficiently. I think that can itself produce a lot of difference. And technology, as I said again, I mean earlier, that is the biggest difference that we should use.
Vasu, I think, given, I mean, if I look at the prominent small finance banks, right, I think they came because they were NBFs. I mean, they're prominent probably, or sort of if I think about the top three scaled up small finance banks, essentially the scale came from the asset side because of the NBFC background. But now that you are all, you're also a bank, right? If you, one way in which banks have made brands is because they would have large concentration of branches in certain regions. So Kotak was very strong on the western side to begin with, and then they expanded out. But when they were strong on the western side, everybody knew Kotak in that. So the original strategy was a lot around building branches and sort of having the frontage and having the sort of the boards out, the billboards out there and so on and so forth in a small concentration of region. How do you see that? I mean, have you followed the same strategy, or you will sort of think about it on a more national basis from going into the deposit-rich collection centers?
See, even as an NBFC, we were present in southwestern north. So we were already present in these three locations. Only east we didn't have a presence, and till today we continue to have no presence in east. And when it came to the liabilities, of course, our home market is Tamil Nadu and a little bit Karnataka and Maharashtra. These are our three main home markets. And so most of our branch network actually has been put here. Because then it can at least ride to some extent on the reputation that we have built on the lending side. It can ride on top of that for mobilizing, deposits and all that. So we have also gone through the same route that our deposit franchise is something we build. We build on regional basis where we already have a good presence on the lending side, and then only then you kind of take it up into other areas. So most of our branches are located in the states where we had a good presence on the lending side. And in terms of customer segment, we have kind of seen it over the last so many years. What we have observed is that our borrowers, their ability to contribute to our deposit base is not very high. We are offering deposit services for our borrowers also. In fact, we have rolled out a recurring deposit for our microfinance customers, for example. And today we have, I think, nearly about 40% of our microfinance borrowers who are our recurring deposit savers, right? But it doesn't add up much to me from a balances perspective. But it adds a great value to my borrowers. It adds a great value to my customers because they are now able to save between 200 to 400 rupees a month very seamlessly. Because I'm going to collect the EMI in a group at their location, and I collect an extra amount for recurring deposit and put it into their account. So it's a great way of saving for them in a very painless manner. And over a 2-year period, they'll be getting about 5,000 rupees plus. So which is fantastic for them. So we can offer a lot of this kind of services for the customers, but it may not add value to me from a balance perspective. So when it comes to deposits, even though we might tag along geographically in areas where we have a strength or we have some level of recognition already, but from a customer segment in those geographies also, we are forced to go out and look for customers who may not have dealt with me on the borrowing side. So we have to go out to the mass and the mass affluent for raising deposits, which is where the money really lies. So there's a kind of a two-pronged approach. You choose geographies where you have some strengths in the market, but using that you have to reach out to a different set of customers who have the money to deposit with.
And when you look at your customer base, do you see them banking with the big banks as well, and they keep a certain part of their savings with you? Or do you see that these are unique customers or these are different segment of customers?
If you're talking of the liability customers?
Liability customers, yes. Yeah.
Okay. So in the liability customer, I mean, as per our own, data or insight into what we get from our own deposit customers, approximately about 30% of our customers, we are, either their first or second banker. But for the remaining, we are not. We are maybe the third or fourth banker. So the whole challenge is how do we kind of increase that, and that's a big story by itself. What's the kind of products and services you offer to them, what makes them want to deal with you from a account perspective, why would they want to move money from some other bank account to your account. So it's a big story all by itself, and there's a lot of effort and work that needs to be put in, which people are working on and all that. But yes, we have to try and move more and more towards providing a set of products or services which will make them want to use your account. And digital is definitely one of that, because the ease of using does make a lot of difference to a customer. So digital is definitely one of that, but beyond that, we have to again see what else the customers would need. I mean, if you see the universal banks, if you see the large banks, of course, they are all providing it already. It's nothing that
Sure.
I'm inventing for the first time. It's definitely not. But again, if you see today, let's say I don't want to name any particular bank, but let's say one large bank, any large bank you take it, if they are acquiring today, let's say 50,000 new customers today, this month, if they are acquiring 50,000 new savings account customers, does it mean that those 50,000 customers never had a bank account before that? It's not so.
Sure.
They also
Sure.
have bank account
They're also
somewhere else.
correct.
Exactly. And they are probably opening the third or fourth account. And then this bank effort will be to try and convert that into a first preference or a second preference at least. So this game is going on even for large banks. It's not like large banks have finished acquiring customers and they have now stopped. And we are all
Right.
new banks to acquire. It's not like that. This game is an ongoing game. And to that extent, we are no different from the large banks. So if I can provide equivalent products and services to a depositor, then I can also try and woo him to make my account as either the first or the second account.
So let's say you start with as a second or a third account for that customer. Over a period of time with service and sort of general experience, if he likes the experience, you can farm him better and sort of acquire more balances. Is that how the journey is?
Yeah, see, we are not trying to take head on with the top end of the client, because there's no point. It's
Sure.
going to take too long a
So you're
period
not
of
going to the
time.
very affluent. Yeah.
Exactly. But there are a lot of customers. For example, if a person has a balance, what we call as relationship value, RV value
Yeah.
of let's say 2 lakhs or 3 lakhs or 5 lakhs in any bank. Now
Yeah.
that doesn't get him a lot of personalized services, and it doesn't get him certain level of relationship with that bank. So we roll out programs where even at that RV value, I will give him a better personalized care and service. And so that's the kind of route that we are trying to say that for you, I let me be the preferred banker.
Understood.
I'll be able to treat you a lot more with reverence than maybe someone else can. And our corporate payroll, for example, I can't go to an Infosys. I mean, I really can't imagine
Sure.
walking into an Infosys saying, please replace some bank and put me as your employee bank for your employees. But I don't have to go and do it to Infosys. I mean, just like in the lending side, just like on the lending side where you have such a huge unmet demand on the informal economy customers. Similarly, on the corporate payroll side, what we have seen is a large amount of SME customers whose
Correct.
employees are not really serviced by the bigger banks. And we have a lending product also to that segment anyway, which we rolled out 2 years back. And that's a big focus area for us to grow also. So we are now reaching out to all the SME customers, the small to low-end mid-corporate customers, and telling that I will give you a great level of service for your corporate payroll. So please move that to me. And there we are seeing
Yeah.
some traction. So we have to really keep, identifying and plugging in spaces like that where it has been existing all along, but not sufficiently well serviced.
Right. Right. In terms of digital, right, the digital strategy, is there any examples you have in terms of how you've kind of stood out in terms of the way you onboard customers, or you sort of their sort of broader digital banking experience? Any kind of specific anecdotes you can tell us?
Okay, so digital is something that we have been wanting to do right from the beginning. Right from we became a bank 3.5 years back, our digital has been a big focus for us. In fact, we put a we created a digibanking team almost when we started the bank itself. And so even though, as I said, we are bank number 108 in the country, but there's a thing called fast tag, the toll collection in highways. So we were the fifth bank in the country to start issuing fast tags, even though we were the 108 bank, as I mentioned. And today the government and NPCI, they have rolled out a project to use a fast tag for parking charge collection. So in Hyderabad airport, that project has been launched to use the same tag for collecting parking charges. And the 5 banks have been shortlisted to do the project, and we are one of them. Similarly, if you see, the VKYC, video KYC, what's been rolled out by RBI, we rolled it out on the 1st of July of this month. And I think, I'm not sure, but as of now, I think very few banks have actually rolled out the VKYC. And VKYC is a game changer, really a game changer, because as I mentioned today, geographies have no more boundaries now. I don't need
Yeah.
a branch in Meghalaya. I don't need a branch in. I don't even have a branch in Kerala, but I can now source accounts from Kerala, even though I have no branch in that state. So yes, clearly technology and FASTag, for example, I remember we paid 40 lakhs for the technology to use a FASTag, and today we are generating 40 lakhs of income every month on that business. So there's a lot of opportunity in technology, and we are very focused on that. We have a separate digibanking team continuously trying to come up with new ideas and new applications from a technology perspective.
And just doubling on this video KYC. So if you acquire a customer in a state where you don't have branches and you acquired him as a full KYC, which is a video KYC customer, obviously you can go to your website, store money, and sort of move money electronically. Doesn't he care about general servicing? Obviously now not many footfalls are in branches, but going and collecting cash and so on and so forth, which you can do from ATM. But that whole branch experience and general servicing ability, calling and troubleshooting, how does all that kind of get managed?
So we are ramping up our services on the mobile and net banking apps. Already, most of the services can be availed over the mobile and net banking by a customer, but there are still a few services which can't be done today. They still need to reach out to a branch. So there's already a project underway. So we got phase 1, phase 2 of that, which will be delivered over the next few months. By
Sure.
end of which we should be able to give almost every service that a customer requires at a branch should be available on his app. Still there may be a few things such as check collection.
Sure.
He can't drop a check on the app.
Yeah.
He still
Yeah.
courier it to me and things like that. That's something that we have to work with. Today regulation doesn't permit you to send a check for clearing unless you have the physical copy with you and you have verified it. So as and when that regulatory framework changes and all that, yes, we will probably be able to roll it in. But minus that, there are these few services which we can't offer on digital, but the rest should be available. And in the next few months, maybe 3-4 months, all of that should be also available. And to that extent, a full KYC customer can effectively use it on a remote basis.
And you mentioned to me that your feet on street, which would be your normal customer acquisition channel on liability side. Now you have video KYC and digi marketing. And what would be the impact of sort of the overall customer acquisition and productivity going forward in this new digital framework?
I don't want to get too much into the
Sure.
numbers part of it.
Sure. No, but just
That's
generally in
not
terms of
very
how.
appropriate. But yes, we are using digital in 2 ways. One is that how can the existing staff use it to improve their productivity? So earlier, before the lockdown, none of us are used to technology. None of us are used to digital at all. So everything was
Yeah.
like physical. People had to go out and meet
Yeah.
a customer physically and open an account and all that. Now,
Yeah.
during the lockdown, we really enabled a lot of customers to just move into our app and download and open an account on their own through our selfie savings account process. And we saw that in the month of April, May, June, we opened about 55,000 savings accounts compared to our average run rate of around 25,000 in a quarter. pre-COVID.
Yeah.
Right. So now the technology is one which is used by our existing staff to do their existing jobs, but in a more productive and more efficient manner, which will improve their productivity quite significantly. That's one way we are using technology. The second is that a complete separate digi marketing team who has nothing to do with the branch network that we have, and their job is only to go out and source customers through digital campaigns and digital marketing, just acquire customers as a new channel which has opened up today, which was not there a month or 2 months back. It was not there. So that's something that's opened up now. And this month, first month, July, is when we are trying it out, because we just introduced VKVs in the beginning of the month. So we are really trying it out this month, and the results have been very positive. I mean, we haven't started advertising much yet on the social platforms, which we intend to do. But the first few campaigns we undertook itself, the effect has been very good. The results have been really, really encouraging. So that's a new channel that we have got suddenly opened up, and that's something that we'll be working on now.
Interesting. Vasu, I'm just going to take some audience questions. I'm monitoring this app, Pigeonhole. Some of them a bit more specific. So one is, this RBI and the licensing norms and other regulatory complexities, there's always this guessing game kind of going on. How do SFBs deal with that? And what's, yeah.
So, yes, so there's so much of discussion going around the ownership structure and promoter shareholding, ownership, listing and all that.
Yeah.
Yes. So, actually, the guidelines are very clear from RBI. There is no confusion on the guidelines, and there's been no change. At least in the case of SFBs, I can say very clearly, RBI has not changed the guidelines in any which way. So we have no grouse. None of us can have any grouse against the regulator on the guidelines of ownership and all that. If at all any of us have got into any kind of a trouble or a difficulty, it is only because somewhere we kind of presumed that RBI will be willing to give us some level of accommodation in meeting certain norms of the guidelines, but those accommodations were not very forthcoming, and to that extent we might be in some spot of trouble. But otherwise, in our case, at least the guidelines have been very clear from the beginning, and RBI has not really changed the guidelines in any which way at all. So that's one thing. Second thing is that, we have, of course, all of us have been really bombarding RBI with our list of woes, crying to them all the time about all the difficulty that we face. So that's something that we have been ongoing communication to RBI. That's the second thing. Third thing is that RBI has come out with a
ownership
on-tap license. Small finance banks, they have come out with sometime, I think the month of November of last year, they have come out with. And that guideline does have one or two extra factors which was not there in the original guideline of our guideline. And that's again a reflection of RBI's willingness to look at things afresh and take a call based on the developments. That's the third thing. And last thing is that RBI has recently set up a working committee, internal working group within RBI, headed by one of their board members, to find out a list of factors related to ownership, related to promoters, need for a promoter, shareholding of promoter, holding company structures, NOFHC, whether there should be NOFHC at all, the entire gamut of ownership of private banks. So a working group has been set up, and so we will all, I'm sure, we'll all of us will be trying to reach out to RBI, giving us our own feedbacks through the Association of Small Finance Bank. Also, I'm sure somewhere down the line we should be giving some representations and all that, and then we'll all be watching with eagerness what really comes out of that working group, and so we'll have to see how that comes. But if you see our list of troubles on the ownership part of it, it's basically very simple. The point is that we don't have a promoter. I think about 7 out of 10 SFBs, we don't have a promoter. We have clearly defined promoters. These 7 of us, because we didn't have a promoter, we couldn't comply with the requirement of RBI that there should be a promoter to promote a bank. Since we didn't have that, then we all went about and created this holding company structure to fit us into the guidelines. And once we did it, then we kind of got caught into that. So it's a little bit, that kind of a thing. Now we'll have to see whether this working group in any way will come out with something which could help resolve some of this naughty issues,
Yeah.
of ownership. Because if you see the destination requirement of RBI for a private bank in terms of ownership is that ideally a private bank should have no promoter. It should be widely held bank so that there's no undue influence of any particular individual or a particular group on the operations of the bank. That's their ultimate destination goal for a private bank. Actually, 7 out of 10 SOBs, we are at that goals, at the destination goal level right today. Right, we
Yeah.
are, because we are completely professional banks. We have
But
no
then this
promoters.
fake entity called promoter holding company was created, which is creating all the knots.
Correct. Correct. So because we didn't have that promoter, we went and created a legal entity which can be then called a promoter. So that's become the bone of issue now. That's become the bone of
Correct.
issue.
Correct.
But in reality, if you see, we are there where RBI wants us to be after 5-6 years. Where they want us to be, we're actually there today. So the question
So
is, how
in
do you then
principle, this
manage
fake
these two?
entity, fake promoter holding entity, which was done for certain regulatory reasons, should ideally, that's the point which needs resolution. And once that is done, then you are
Yeah,
pretty much there where you want to be.
correct.
Vasu, one more question on consolidation. So there are two types of consolidation that can happen. You are amongst the leading small finance banks, and some of the other minor small finance banks, if not minor, smaller small finance banks, so to say. Uh, would that get consolidated over time and you would kind of grow in size? That's one question on consolidation. And second is, would you, over a period of time, roll up as these larger banks become larger, which is clearly the theme, and the small finance banks kind of roll up to the larger banks? Just responses on these two.
Okay, so the M&A is something which is very format agnostic. So for example, if we want to do an M&A, it can be why only another small finance bank. It can be anybody.
NBFC.
It can be another. It can be a universal bank also. It can be an NBFC also. It can be a SFB also. It can be anything. So I think the format or structure of the entity is very not really. It's agnostic of that. So any M&A is not because another SFB is available or another NBOs is available or something. So whatever be the normal requirements for an M&A, how does it help you? In what way does it complement your abilities and skills? How does it add value to both the shareholders of both the entities? So I think if all these questions are properly answered, then any transaction can actually happen. So I mean, it's very difficult to say whether I will buy or I will sell. I'm not going to answer either which way.
Yeah, of course.
But I think it's all a question of the evolution of models as they go by, and what's in the best interest of the shareholders of both the entities. So if both entity shareholders are going to gain substantially, I think typical M&A should ideally happen in that scenario. And if it doesn't help people, why should it happen? So even a small, as you said, small SFB, for example, it's not like they need to definitely sell out at some point. They can remain small so long as their shareholders are happy with the return that they are generating from that entity. They can also continue to do business. And as I said, growth opportunity is immense in the informal lending sector. So I think it just depends on the entire framework of the underlying factors of typical M&A reasons.
Sort of moving on the lending side, there's a big event that has happened. Hopefully it is transitory. Could you talk about different segments? You look at three segments: microfinance, used vehicles, and small entrepreneurs, where you do small business loans. How has that impacted the cash flow of these segments? Where do these customers stand? How close they are to rehabilitation? Some color if you can provide across segments.
So this lockdowns and COVID has had a big impact on the informal customers, very big impact. And we have been in touch with our customers. In fact, we have, I think, about 22 lakh or 2.2 million microfinance customers, about 200,000 small business loan customers, about 100,000 vehicle customers. We have touched base with every single customer of ours. We have met all of them, so we have a good idea of their position, where they are, and all that. And we have to play a very supporting role at this point in time. We really don't want to go and kind of pile the pressure on them to somehow force them to pay up one EMI or two EMI, because our life doesn't end with collecting one or two EMIs from them. I
Yeah,
still
you
have
want the
another 2 year,
relationship.
3 year, yeah, 2, 3 year, 4 year, 5 year. That rest of the transaction has to be still seen through. So, so we really want to work with them, be with them during this period of difficulty. And what we have seen is that during April, May, practically our customers were down and out. Almost all of them are down and out, because there is no activity, there's no life. And our people are largely self-employed, largely daily, earning people. If you open
Yeah.
your shop, if you do your business, you got money for the day. If you don't, then you just don't have money.
Most of them are
So
micro entrepreneurs, right? Yeah.
almost all of them,
All of them.
all
Yeah.
of them are micro
Yeah.
entrepreneurs, and our loans are livelihood loans. We don't have consumer loans at all. It's all
Right.
livelihood loans. So that being so, in fact, we do classify in our June update. We have classified a part of our customer as salaried segment. But what we mean by salaried also is that the the biggest earning member of the family is a salaried person, but then there's somebody else doing a business and in that family, and typically the income of the family is taken. It's never the income of one person who is taken. So
Sure.
we almost all our loans are livelihood loans. So they need to do business to be able to earn and manage their family and pay the EMI back to us. So we have seen that post May, the recovery has been quite sharp, quite fast and quite sharp. We have seen a significant number of our customers come back and open their shops or whatever business that they're doing and start
Sure.
earning money again. So from a 90% moratorium in April, May, it came down to 50% in June. And we expect that to keep going down as the economy, as the country opens up and allows more activities to start happening. But we also seen that people who paid in June have stopped paying in July, because there is a fresh lockdown, imposed in their district or in their zone by the government. So
Sure.
June they paid, and July they have not been able to pay. So
Hmm.
I think it's all a question of how soon the country kind of comes back to normalcy. The intent of these customers generally are very good. We've never had trouble with them, because we have seen enough. Like we had a flood in Chennai. It was a very major
Yeah.
flood about I think 3 years or so back, and more than about 150,000 odd clients were impacted in that flood. But we didn't, obviously, for 2-3 months there was no payments at all from them. But then we never lost a penny from them ever again. I mean, all of them paid up later over a period of time. And we have been having cyclones everywhere. We keep having cyclones and other kind of stuff. They always come back. They get disrupted for some time, and when the business restarts, they always come back, and the relationship is back to normal. So, so here also in this current crisis, our approach is very similar. We don't want to unnecessarily hassle them. When we meet our clients and talk to them, the topmost concern that we see from them is how to keep some cash in their hands. They all want to keep some cash in their hands, because they are deeply worried that some
They
medical
may not earn
emergency.
something in the future.
Their earnings is still not regular. It's still not regular. Either there's a fresh lockdown, says it's zero, or even if there's no fresh lockdown, it is like 10 to 6 or 10 to 5 or something like that, is a restricted timing, and the crowd is not just the same. So the cash flow is not completely back to normal, and they don't know whether there will be a fresh lockdown a week from today or 2 weeks from today. They don't know. And so they want to keep some cash with them, because there's always this fear that there could be some health emergency and they just need some money in hand. And
Hmm.
then the education expense. That's again a top concern that we get from our customers when we ask them, what's your concern today? They say this two, mainly these two, that, what will happen if some health requirement comes? I need money. And for school fees, I don't have cash.
Sure.
I don't
Sure.
have cash. What am I
No, it's
supposed
a
to do?
very fair.
So these two are
Uh,
the two main things that we get from them. So at this time, two things we are doing. One is we are not pressurizing them to pay back. Okay, if you have surplus cash, if you're comfortable, give me, I'll take it. Otherwise, we explain to them in writing, we explain to them what's going to be the effect of additional interest, so they can make their choices based on their level of comfort. Second thing is that we are also open to giving them a fresh loan, so that it kind of puts them back on their feet and gives them the comfort that they can take care of the current crisis and still come out of it. So on both ways, we are definitely sitting and working with our customers, and I think it's a question of time before they will become able to come back.
So suffice to say, I think the simple word is, if they operate business, they have no intention not to repay your loan. If they have, the business runs and things come, the activity comes back, that results in income which repays your loan installment. I wanted to kind of check on the used vehicle customer segment, because there is a transportation element there. What has been the impact on that particular segment in terms of their ability to ply their vehicles, so to say? Given that these are not interstate type of transport, these are more local transport, I guess. So if you can give some color there on their activity levels here.
So in the month of June, we saw nearly about 35% plus of our customers, we got a feedback they're able to operate their vehicles. Now, July, we are getting a, indication that more customers are able to ply their vehicles. So it might be about 50 to 60% of our customers probably are able to ply in the month of July. And so as they are able to ply, yes, they will start paying, but we have to give them the time to ply. Now the question is, if the customer's intention is good, then we have no problem. We can give them any amount of time. But if his intention is bad, then I don't want to wait. I know that it's going to be lost. As well face it fast rather than delay it. So what we have done in vehicles, specifically in commercial vehicles, what we have done is that we have kind of categorized the entire portfolio into a high, medium, and low risk category based on various parameters. One of the main parameter being what is the equity contribution into the vehicle of the customer vis-a-vis ours. So wherever the customer's equity is too small, that's automatically categorized as a high risk customer. So we kind of categorize our portfolio into these three. And the high risk category, I think we had about nearly about 20,000 odd customers who fall into that high risk category. So we have reached out to every single one of the high risk category customers, and we told them that, if you are able to pay June or July EMI, please go ahead and pay. If you are not able to pay, I have no problem. I'll give you a further moratorium, no issues. But please produce your vehicle to me. Please bring it for an inspection. Let me inspect. Let me confirm that the vehicle is in good order. Then I'll give you the moratorium. And the purpose of that was, one, to confirm that our asset is intact and of good quality. But more than that, it was also to confirm that the customer's intention is good. Otherwise he won't produce the vehicle if his intention is bad. And you would be surprised that almost 95, 96% have already produced their vehicles. Only a few percentage that's still work in progress. And out of the vehicles produced, 99 point something, the quality of the vehicle has been found to be good. So the customers are maintaining their vehicle properly, they are keeping it in good order, and they are willing to produce it for inspection when we ask for it. I mean, what better indication of intent than that we can expect from them? So you see that traditionally, that's why our NPAs have remained very, very comfortable. Around 2.7 to 2.8% is where our NPAs have remained steady over the last so many quarters. Because I think fundamentally our customer segments are people who genuinely, want to be good to us. Their intention has been found to be very good over a long period of time.
And in this event, you've not seen cases of moral hazard where intent has moved because of this situation. Is there any sort of sense that you feel there?
See, that's what I said. In vehicles, as I said, if they didn't produce the vehicle for inspection, then I will know that his intention is not really honorable at all. And in the small business loan, actually, we don't even have to do that exercise because my LTV is less than 40%. 60% of the value of the house is the customer's equity. My equity is less than 40%. So the customer's stake is so high that I don't even have to verify his intent in the small business loan. And in microfinance, though, it's a time-tested model over the last so many years. So we don't really see that moral hazard playing out here.
And on microfinance, any color you can provide in terms of certain areas or geographies or urban, rural, where you're seeing any behavioral differences?
See, today, that's what one is that we have no external interference in microfinance today. Whatever happened in
Political,
demon period,
yeah.
it was all political interference which happened in demon, but it's not there today. So that's a big relief to all of us. In terms of different behavior of clients and all that, yes, the disruptions have been largely urban, except the first 1 month or so where the entire country was brought to a standstill. But after that, the second, third, fourth imposition of lockdowns are largely urban areas. Very, very little. I don't think there's been any lockdowns in rural areas. Because of that, the repayments or the livelihood activities of customers are more consistent in the urban, semi-urban and rural. In urban, it's kind of stop-start as of now.
Understand.
They started after 20-25 days, suddenly there's a stop for 2 weeks, then it restarts again. So there's been a little bit of, interrupted coming back in the urban areas. And that naturally has its effect on both livelihood and repayments.
Understand. So I'm going to take audience questions. If anyone has any questions, actually you can unmute your mic and ask. Otherwise, I'm going to follow the questions on the Pigeonhole app. So there's a question by Jeff. Microfinance loans and other loan products are quite different in settling and operations. How do you manage to build out the operation without duplicating?
Sorry, come again?
Yeah, I said microfinance and other loan products are quite different. So there is microfinance and there are other segments. How do you manage to build out the operations without duplicating?
Okay. So actually what we have done is that our entire small business loan, which is 40% of our total book, that is something which rides on top of our microfinance structure. So the staff are very similar. The customer segment is more or less the same. The geography is absolutely the same. The only thing is, of course, we do a credit appraisal, individual credit appraisal in small business loan, which we don't do in microfinance. But otherwise, there's a large amount of overlap between microfinance and the small business loans. So there's a lot that 40 and 23%, 63% of our business, there's a very strong amount of coordination and leveraging which happens. As far as vehicle finance is concerned, that's a very different ball game completely. So it's just got a separate structure all by itself.
And there's one more question. SBI always, banks announce micro lending programs, and SBI announced a big micro lending program. Do you see any large bank competition? You worry about it at all, or it goes back to the same answer, which is it's very hard to build this business and it's more specialized?
So we got to get more details. I don't have details of. I also remember reading a news report about State Bank's announcement, but I have not got any further details through the public space. So we don't really know what it means. But I can definitely say with knowledge that the way we do the business of microfinance in terms of field level, forming a group, our own staff going and doing it, our own staff conducting group meetings, collecting the money and all that, large banks can't do it. It's just not possible because the level of operating risk involved, the level of operating controls you need to put, the amount of management bandwidth it just takes away is so high that large banks just can't do it. It's not possible at all. So their model, if at all they want to do, they might probably ride on other NBFC MFIs by appointing them as a BC and getting them to do the field work, and they just provide the funding and take the asset on their books maybe and give a commission to the NBFC as a BC and all that. That's definitely a very workable and a very sensible and workable solution for both the NBFC and the bank. But directly a large bank getting in and doing it, replicating our model by a large bank, I think is definitely not possible.
And Vasu, one more question on collections. Is digitalization of collections possible across for the customer segments that you look at?
It's not easy. It's not easy. It's not really easy because microfinance, we could look at asking them to pay through an app or something like that. but we don't even want to go down that path, because in microfinance, the group lending, the security is only the group bonding and the group guarantee. And the group guarantee comes in only when there is a group relationship between the people. And the relationships are built only when people meet each other frequently. So if people don't even meet each other, the level of relationship can never be sustainable. And so in a microfinance, conducting the group meeting is too critical. Too critical. We want all
It's
people
part
to
of
come to
the
that group meeting.
credit culture
It's,
almost, yeah.
yes, it's part of the credit requirement of the product itself. And if I
Yeah.
allow them, if I offer them the option of paying digitally, and if a customer ends up paying in the morning, the group meeting is, let's say, at 10 o'clock, and she pays it early morning, then she might say, why should I come to the group? I already paid.
Yeah.
And if people stop coming to the group, then the microfinance model doesn't exist any longer.
Doesn't.
So we are not even very keen to go down that path, though we know that there could be a lot of cost saving by making digital payments from them. But we are definitely worried on the model itself breaking up.
Yeah, and there's sort of one more question around collections, or finally resolution of the situation. Let's say, as activity levels improve, but there are some segment of customers which need more serious rehabilitation. Uh, how does one kind of resolve those very extreme cases, which could be last 4-5% without quantifying it? But how do we address those corner cases finally?
So one is this moratorium RBI has given. So whatever it will run through August, anyone who needs it can take it up to August. Now there's a lot of discussion in the newspapers about RBI, thinking of how to support beyond August. So there is some representation that I think even the banks are making. So there's a toss-up between one more moratorium or allowing the banks to do a one-time restructuring. So it's kind of a toss-up between the two. We don't know what finally will come out from RBI. But whatever comes out, we'll have to see what comes out and then see how to use that. So if there's finally some level of sticky customers who are very good, intention is very good, but their capability is kind of badly impacted for a period of time, and they will definitely come back. If supported now, they will come back later and be able to manage and not only repay us, but also earn their livelihood back to the old levels. Then we will probably look at restructuring for them. Even if RBI doesn't come with a dispensation, we might still go ahead and restructure under the regular IRAC norms of RBI, which means I'll then classify him as an NPA, make the provisions for an NPA and all that, but support the customer through a restructuring, because if that's going to help him in the long run, and which means that will also help in the long run, then we may be willing to take the short-term pain of treating it as an NPA, making
classifying as NPA.
Yeah. So that's something that we already discussed, and we are very clear. We are waiting till August. If RBI doesn't come with anything, neither moratorium extension nor a rescheduling option to the banks, and if customers are still not fully recovered from this impact, and if there is that, as you mentioned, some last bit of percentage of customers who need some support, we will be from our side open to do that, even at short-term pain to us.
Understand. Yeah, I mean, it's about the relationship continuance rather than just the immediate pain with it. Yeah. Great, Basu. I think we have crossed 10 minutes beyond our scheduled time. I think we have tried to ask most of the questions. I think most of the questions got covered in our discussion as well. But thank you, and all the best. And it's great that you've been supporting your customers through these difficult times. And hope Equitas ends up evolving to what we were discussing, to a much larger small finance bank or a universal bank.
Sure. Thank you. Thanks, Gautam, and thanks for hosting.
Great.
Thank you.
Great. Thank you so much. Bye-bye. Take care.